Alrighty, y'all. Thank you so much again for those who have registered for this webinar and attending right now. Again, if you weren't able to make this time frame, totally understandable, and that's why even if you're attending now or haven't attended, we will be sending you guys a copy of everything. My name is Deja Logan. I am a mortgage loan officer here in Las Vegas, Nevada, and then I also have my co-host.
Hi, everyone. I'm Dr. Whitney Griffin, and I am from Los Angeles. I moved here to Las Vegas, and I met Deja, and we quickly fell into business with each other. So I'm really happy to be here in her office, soaking up her good energy. We decided not to do this separately, even though we're on separate computer screens. So I hope you feel the energy and the love today.
So we put this class together because people need to know what we do. So Whitney shared her story with me just a little bit, and so some pretext where if you are listening, you might fall into one of these categories and be someone who might see value and might not realize. And so we wanted to share it with you all. Whitney would say a little bit about how we came together to put this webinar together.
Yes, we put this webinar together because well, people need to know what we know. That's the bottom line. I was uninformed and unprotected. And I know that as smart as I am with my doctor having self, if I didn't know this basic foundational information, I know other people probably don't know it either. So I shared my story with Deja, and she made the comment over smoothies, of course, that maybe we should put our smarts together and share what we know with people who are ambitious yet unaware. We want to put you in homes, we want to keep you in homes, but we want to make sure you are making informed decisions, not decisions based off of what you scroll through on social media, although that is a very fun place as well. But we're both licensed, qualified professionals, and we want to set the record straight today. So thank you for joining today.
And if you guys have any questions, of course, after we do each presentation too, we'll be on the lookout for your questions. And at the end, we'll be able to answer them for you. So getting into my part, again, I'm a mortgage loan officer. So if you are purchasing a home or an investment property or refinancing and pulling equity out, anything that has to do with home ownership, you're going to contact me because I'm going to give you that financing and the tools and the resources to do so. So right now in this webinar, if you happen to be currently a homeowner, I want you to think back to when you were in the process of purchasing a home. Did you understand everything that was associated in your mortgage payment? Did you understand what principal, interest, what property taxes meant? Also, homeowners insurance versus mortgage insurance, which is the main topic today about mortgage insurance. And do you really know how that affected your monthly payment and your upfront costs? Did you also know how it can affect you right now and ways maybe you could get rid of it and lower your payment, or what the necessity was in order to have it put as part of your mortgage payment? And if you are an aspiring future home buyer and interested, this whole topic is something that you should know and realize and see in all the steps on becoming a homeowner. Again, where your money is going towards. You're making the biggest purchase of your life. So it is very crucial and essential that you know where your money is going towards. So getting started, let me pull up my presentation. Alrighty, so let's get into it. So understanding your mortgage payment. So what makes up your monthly payment? And you'll hear anyone in real estate as a realtor, a mortgage loan officer, anyone who touches the homeownership file, PITI. And what does that stand for? It stands for your principal, interest, taxes, and insurance. So getting into principal, that is the amount that you borrow that is based off of the loan amount minus what you put as your down payment, if you did put any down payment down. Portion of your payment that reduces your loan balance. Then there's interest. The cost of borrowing the money determined by your interest rate and loan program fluctuates. It changes all the time. And what I mean by interest rate isn't one number fits all. Again, it is just based on so many different factors. Your FICO score, your debt to income ratio, your down payment, the loan program itself, and how much the loan is going to be. It's all factors and risk factors that is included and determines your credit score. And that's why you'll always hear about FICO scores, your credit score. The higher the score, the better your terms, meaning that you'll get the lowest pricing, probably the lowest interest rate we can give you at the moment too, compared to someone that has a lower FICO score. And on paper, again, life happens, but on paper, think of it through the process. It's just all looking at risk. The lender is just looking at risk, and that's why sometimes people's interest rate can be higher. It's all a risk factor. Then there's your taxes, typically collected monthly and held in escrow. Property taxes paid to your county. So every home has a different set of property taxes associated with it. And common enough, if you do have talked to people that are homeowners and they say their mortgage payment fluctuates, that's mainly based on taxes. And when your home is assessed, taxes can either stay the same, it can go up, it can go down. It just depends on market trends and around surrounding communities and what they're appraising for. And I'll get a little bit more into what is held in your escrow account in the next couple slides. Then there's insurance, homeowners insurance for protection. So that is a necessity. Thankfully, in Las Vegas, we don't have major natural disasters. So our homeowners insurance are honestly pretty low. Homeowners insurance protects the home. Theft, flooding, damage to the property, that is what homeowner insurance is for. Now, your mortgage payment may include something called mortgage insurance, also known as MI, which is again the topic of our webinar, and that is depending on your loan type, which I'll get into the next slide. Now, mortgage insurance, funny enough, does not protect the home, and it does not protect you as the borrower. It protects the lender in case something were to happen where you default on your mortgage. Again, it's all risk factors the lenders look at, and sometimes you might have mortgage insurance in your payment, and let's go and take a look at how that affects your monthly payment, how to get rid of it, and how we can strategize to make it as low as possible for you. So escrow, what is it? So lender holds money for taxes and insurance. It's called an escrow account. Can adjust yearly. So again, that property taxes ensures bills get paid on time. So there's times where people might have separate payments. They have their principal and interest in one, and then their taxes and insurance they pay separately. I personally don't advise on that. Normally, especially with your FHA and conventional loans and first-time home buyers, you're going to have all of it all together because we don't want any surprises and we don't want you to default because that's going to show up on your credit report, and we really don't want that. So there's a thing called also a shortage. Equals higher payment, meaning that your property got assessed and say your property taxes went up a little bit. Well, that doesn't coincide with how much you're paying on your monthly payment, so they call it a shortage. So when you do make your payment or get a statement in the mail saying that you're short on your escrow and your property taxes, that just means your property was reassessed, and now your mortgage payment will reflect what the new payment should be. Then there's a thing called an overage, equals a refund. Sometimes you can overpay on those escrow accounts, and that's just going to hold extra funds for in case when there is an influx, you would still have that money saved to go towards that influx of your payments. Now, so we're going to talk about the three most common loan types. There's a lot of loan types out there. There's so many. If there's one that you are interested about, please send me a message and we can talk it through. But I'm going to talk about the three most common here in Las Vegas. And the one I'm not mentioning right now is the rural and the USDA loans because, again, being in Las Vegas, USDA loans aren't approved here. We would have to get out of the county a little bit. So let's talk about FHA, conventional, and VA. So FHA loan, a couple highlights. You can put as low as 3.5% as your down payment. Flexible guidelines, meaning that we can take a credit score as low as 580. It also will accept higher DTI ratio. Again, DTI, your debt versus your income versus the mortgage payment all together. So if you got high debts and it's a little close to that income level mark, we'll be able to over approve you on that. And then also interest rates are typically on the lower side compared to other loan programs. Mortgage insurance is required for 11 years or for the life of the loan, depending on your down payment. Years beforehand, it only changed recently this year, or I believe last year. FHA, you had to have mortgage insurance for the life of the loan. It didn't matter how much you put down, it's going to stay there. You can't remove it. Recently, guidelines had changed that if you put as low as 10% down or up, after 11 years, you'll be able to remove mortgage insurance. There's also a thing called upfront mortgage insurance, and that's only with FHA loans. It's required, can be financed or not financed. It's just a set amount, again, just based on the loan amount, and that is included in your payment if financed, or if it's not financed, it'll just be a fee that you'll have on your closing costs. Then there's the conventional loan, another common loan type. You can put as low as 3% as a first-time home buyer, primary home, or as low as 5% as your down payment, or up, fewer fees with stronger credit. So conventional loans do have a higher interest rate than FHA. But again, there's different ways to get to a lower interest rate. There is fewer fees when it comes to closing costs as well. And mortgage insurance can be removed once you hit 20% equity. So even if you put 5% as your down payment, if your home appraises high, or let's see, you after years and years on end, you're paying down your loan amount and you've built now 20% equity in your home, you can remove it without even doing a full refinance. You just request with the lender to drop your mortgage insurance and they'll drop it for you and save you some money on your monthly payment. Then there is VA loans. VA loans you can put as little as 0% down if you are eligible. You have to be eligible if you are a veteran, and we can check that for you. There's no mortgage insurance. You cannot have a mortgage insurance as a veteran using a VA loan. Includes a VA funding fee. It may be waived depending again on disability. VA, if you're not sure and you're someone that might be eligible for veteran discounts or incentives, please reach out to me. I can see if you're eligible for that. So what is mortgage insurance? So mortgage insurance, again, emphasizing, does not protect the buyer. It protects the lender if you as a borrower default on your mortgage payment. So not saying that you're paying all this extra hundreds of dollars on your mortgage payment thinking that if you happen to lose your job or something were to happen, you just can't make ends meet and make a monthly payment, that this funds that you're paying is going to be able to pay towards your mortgage payment. It does not. It just makes sure the lender gets paid because you default. And again, it's based on risk factors. And we know life happens, but lenders, underwriters, they're very black and white. They're very just looking and seeing what's on paper. Always lower down payment allows lower down payment programs though. So that is why you can put as little as 3% or 3.5% down payment, which actually can save a lot more upfront costs when you do initially purchase a home. Not the same as homeowners insurance. Like I said, homeowners insurance protects the home, adds to your monthly payment, except for VA, because again, VA, no mortgage insurance, but depends on, there's not one set amount that you'll have as a mortgage insurance per program. Again, it just depends on you and your terms. So mortgage insurance by loan type, again, FHA loan required on every loan. Mortgage insurance premiums is what it's called, stays for 11 years. If you put 10% plus down, or for the life of the loan if you put anything under 10%. Conventional loan required if you're putting less than 20% down. Removable when you reach 20 to 22% equity. It just, again, depends on the property. And then VA loan, no mortgage insurance, and then there's just a funding fee for one time. So how does mortgage insurance affect your payments? So mortgage insurance cost varies based on credit score, down payment amount, loan type, and loan size, conforming versus high balance. Again, this is all risk factors. So credit score, higher the credit, we always say 740 up is the sweet spot to get the best pricing on your interest rate and your payments and your terms. Down payment amount too, the more also you put down, even though you can put as low as down, but the more you put down as well can affect how much your mortgage insurance is, because again, we're all looking at risk factors. If you financially have savings, if you're good standing in your credit, never defaulted, never been late, the lender isn't going to look at you as a big risk compared to someone, maybe life happens and no shame in that, but on paper, again, the lender's just looking you as getting this big loan for your home as just a risk factor. So again, lower mortgage insurance equals lower total monthly payment. Strategy, mortgage insurance, use mortgage insurance temporarily, then remove it through equity or refinance. So again, there's ways to strategize. And another take two, home ownership is not a one size fits all. So it's not black and white. So your neighbor, your friend, your family member will not have the same terms as you. So just remember that we give grace. Here is a little example that I have, and maybe you can relate between borrower A versus borrower B. Maybe you're somewhere in the middle. So this is going to be based on an FHA loan. You're purchasing a $400,000 purchase price. So borrower A, she has he has a FICO of 620. They're going to put 3.5% down because that works for them. Their interest rate is 6.375%, APR of 7.128%. Their mortgage insurance is going to be $172.97. So now just estimating based on now their principal, their interest that they have, their property taxes, average out in Las Vegas, now adding mortgage insurance to that, their estimated monthly payments looking like $2,884. Now, borrower B has a FICO of 760. They're putting 10% down, interest rate of 6%, APR of 6.752%. Their mortgage insurance is lower. Even though using the same program, they're only going to have $149.18 mortgage insurance. Again, same, I did the same calculations with estimated homeowners insurance and property taxes, but their payment now is going to be $2,606. So you can see the difference there. Big factor that also made the difference too is how much they put down. Sometimes, in some cases too, again, depending on the loan price, even though you might have the same credit score on the lower side, but if you put different down, like in this scenario, you can see there's going to be a difference in mortgage insurance as well. Borrower B, though, will be able to remove mortgage insurance after 11 years. Borrower A is going to keep mortgage insurance for the life of the loan unless they ever refinance into a conventional loan or sell their home. So how to lower a mortgage payment? We're going to increase your down payment. We're going to improve your credit score. Choose a program with lower mortgage insurance or no mortgage insurance at all. Again, it just depends on you as the borrower. You are able to also buy down the interest rate to have lower payments, lower debt to qualify for better pricing, and refinance, of course, when rates drop and save you money, and kind of just look at everything as a picture of a whole all together and see what is going to fit you best in, with your monthly budget payment, and then also what upfront cash and what you need to do to purchase the home on the first time. Again, homeownership is not one size fit all. We're able to create and structure specifically catered to your needs and your goals. When does refinancing make sense? So again, removing FHA mortgage insurance if you're eligible. Drop conventional private mortgage insurance. So again, on a conventional loan, you hit that 20% equity, you can just drop it. Lower your rate. Accessing your equity, cash out refinances. Reduce payment for long-term savings or debt consolidation. Sometimes just looking at your debt in whole, and even though you might risk of getting a higher interest payment too, you just got rid of months and months worth of credit card debt. And now you only have one payment, which is going to be your mortgage. So again, different factors, different circumstances of why you might want to refinance and how it might benefit you as well. So final takeaways from me. So principal, interest, taxes, insurance, also known as PITI, is your full mortgage picture, not just fully focusing on the rate. There's different factors. Loan programs affect mortgage insurance cost, plus long-term savings. Choosing the right mortgage strategy can save thousands, and I'm here to help you to understand your options clearly. Again, when you're purchasing a home, it's what's going to benefit you now. I'll be able to determine how in the future we can help you even more. So again, thank you so much for listening. My part of the presentation, remember my job is to put you in a home, and I'm going to have Whitney teach you guys how you're going to stay there.
Hey everyone. So as Deja said, she's going to put you in the home, and it's my job to keep you in the home. So my name is Dr. Whitney, and I am a health and wealth doctor, as well as a psychology professor. My PhD is in educational psychology. I graduated from the University of Washington. So I see how people learn. Isn't that cool? This is at Cerritos College. I am educating middle-class families and business owners on how to BPP. As in, you down with BPP? Yeah, you know me. Yeah, I know that's right. Build, protect, and preserve your wealth. And it starts with this question. What if the unthinkable happened? Your home is your family's biggest asset, but it's also your largest debt. And real estate is one of the most important investments you'll ever make in your lifetime. So, congratulations, homeowners. You're in about 50 more times debt than you've ever been before. And experts say that mortgage debt is among the best kind of debt to have, but it is debt at the same time. So, as long as you keep making those mortgage payments on time every month, you should be good to go, right? But what if the unthinkable happened to you? What would happen to your family and your home if your income suddenly disappeared? Does that answer bring you peace, or perhaps it disturbs you? There are certain events that could hinder or eliminate your ability to keep up with those mortgage payments because life does happen and life does get in the way. But I want you to know that you do not have to die to be protected. That's the old way of thinking of insurance. I'm going to show you how this type of life insurance with living benefits makes it possible for you to stay alive and protected. So first, let's define our terms so we're speaking the same language. MPI, mortgage protection insurance, is a type of life insurance. It's designed to pay off your mortgage in the event of death or illness. So know that, as Deja was saying, your mortgage lender demands homeowners insurance, not an option. But that protects the lender and the home. What about you? Where does that leave you? Well, that's where I come in. Some key terms for us are MPI versus PMI. Mortgage protection insurance protects your family. Yeah, we like that. We like when our family's protected. It will pay the mortgage balance to the lender if you pass away, and it is optional. You do not have to have it. Unlike PMI, Deja shared with you, it is mandatory if you put down less than 20%. No options. It protects the lender, not you. People in Zoom world, people on the internet, you're not protected with PMI. It pays the lender if you default on your loan. The lender came up with it, so the lender's looking out for their best interest. You can't blame them. But someone needs to look out for your best interest, and it needs to be you. And don't you want to get your own policy that follows you around? For example, if you have a job that offers you health insurance, that health insurance does not follow you around, it's not private. It is owned by the company. When you leave that company, you are now unprotected. So mortgage protection insurance, as you've learned, pays the lender directly. It will usually decrease with the mortgage. There is underwriting, but it does not include a medical exam. Woohoo. But term life insurance, this is the private kind of insurance, and this is what we specialize in. We specialize in term life insurance and life insurance policies, this one on the right, because you can access the benefits while you are alive. That is what living benefits means. It pays the beneficiary tax-free. There's no death. There's only diagnosis. Your payment will stay level. Your premium pays level for the length of the term, and it usually does require a medical exam. So if you do have a term life insurance policy right now, what you probably have is terminal illness covered. But we connect clients with companies at no extra cost to coverage for terminal illness, critical illness, and chronic illness. So if you know someone who has survived a heart attack, I do, a stroke, Deja's raising her hand, I certainly know cancer survivors, then you know that health insurance doesn't even cover the cost of long-term care, definitely not your medication. And what it's not going to cover is your mortgage, kids' tuition, but living benefits will. Let me show you how. How do living benefits work? You purchase a policy for a specific term, let's say 30 years, because that goes hand in hand with mortgage terms. You pay a monthly premium. If you are diagnosed with a critical, chronic, or terminal illness during the policy will pay you out in lump sum. To do with what you will. It accelerates that death benefit up to 100%. It used to be called accelerated death benefit, but that was scary. So now we switched it to living benefits, but it's the same thing. So maybe it pays for the rest of your medication, maybe a vacation. Maybe you build a yoga studio in your home in addition to paying the mortgage off. So I don't sell mortgage protection insurance. What I sell is this private type of life insurance that follows you around wherever you live, wherever you work. Because our mission is to make sure families are protected from losing their homes and assets due to unforeseen medical expenses. You and your family should be able to stay in your home mortgage free. The main benefit, hard to put a dollar sign to this, but peace of mind. Knowing that your family won't lose their home, that's the benefit of having life insurance. Additionally, it goes above and beyond that. You protect your legacy. Your home remains an asset, not a liability. I don't want to pass on debt to my children's children. I want to pass on wealth because I don't want anyone to be evicted in case I get sick. You know what we're finding? A lot of people are getting sick and they're going to work sick or they're selling off their assets, even people with the good kind of health insurance. So the key with living benefits is that you can be alive to receive them. You do not have to die to use your life insurance policy. What does it cover? The primary trigger for living benefits is illness. which will accelerate your death benefit up to 100% of your policy while you are alive in lump sum. Oh, did I mention it's tax-free? I'm not making this up. It's IRS code 7702. So for all of my Las Vegas residents, think of our area code, 7 plus another 702. Very smooth. It's not too good to be true. It is tax-free. And you can use the amount, what my financial coach did when she shared this information with me, and I immediately took her up on it. She asked me, how much more do you have to pay on your mortgage? Okay, great. That's the foundational number of your life insurance policy. We'll use that as the base and we'll only go up from there. So now I'm protected. No defaulting here. So who is this for? Who am I talking to? Life insurance should be a strong consideration for you if you are breathing. Also, if your spouse or partner could not afford your mortgage payments alone, time to ask the tough questions. What if you have children or dependents? Maybe you're taking care of some parents or in-laws who rely on you. Or what if you want to become your own bank and use assets to build other assets? Because I'll tell you one thing about wealthy people, they don't trade their time for money. That's not what they're doing. That's the middle class's job. They use their assets to generate additional income. We partner people with life insurance policies that accumulate cash value. So it grows while you're asleep. Can I get an amen? For money while I sleep. So let me dispel some myths. You might say to me, I can't use my life insurance until it's time to bury me. Mm-mm-mm. Well, our partners or the companies we partner clients with, they provide cash value policies, which you can access through either a policy loan or a withdrawal as potential supplemental income. You will not be taxed on it because it is not considered income. It is a loan. Using life insurance as death insurance, that's the old way of thinking of it. Another myth, MPI, PMI, whatever. The government's just making things up. They're all the same. No, 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 not so. PMI protects the bank, MPI protects your family. I will tell you, someone who knew the value of life insurance policy, a little man by the name of Walt, last name Disney. Walt Disney could not get a loan from the bank to open up his dream career, the happiest place on earth. The bank said no. Sorry, sir. And Walt Disney said, that's okay. I'm a wealthy person. I'm not a middle class person. So he borrowed from his life insurance policy to create Disneyland. And I looked this up because I needed to know. That company rakes in 18 billion with the B dollars annually, globally. All because Walt did not give up and used his life insurance policy as an asset to build another asset. So this is a change in mindset as well as a change in your financial foundation because everyone deserves to be protected. And you say, well, I don't have a home yet, Dr. Griffin. I don't need a life insurance policy, Dr. Whitney. Well, I'm gonna tell you a secret. Your house, your car, your job, that's not your biggest asset. Your biggest asset is you. Your ability to earn income is your greatest asset. Do you want to protect your biggest asset, or do you trust the government's Social Security program to look out for your best interest? I say Social Security because it's laughable that people my generation and younger are going to have Social Security. Yeah, right. We need to save ourselves. We are the help we've been looking for. You say, well, if I refinance, I might need to reevaluate my life insurance policy. Well, I'll tell you that our clients, they receive annual financial checkups to reevaluate whatever wealth building strategy we've put together for their needs. So evaluation is built into our system. When you work with us, our services are free to the clients. We do not charge you to evaluate your life and your financial goals. Many companies do, but we believe in education as our mission, and that's how we run our system. So, this is my favorite quote from Maya Angelou because she gets me together every single time. Do the best you can until you know better. Then, when you know better, do better. Securing your home ensures that you pass on wealth and stability, not debt. It is a financial step, or it's a foundational step in building a lasting legacy. So when do I talk to Dr. Whitney? When I'm talking to Deja? If it's before Deja, during Deja, after I close. I would say that applying to life insurance is free. Why not now? Don't cost you anything. So let's get to it. Here's my information on how to build, protect, and preserve wealth because we are a mission-driven company. We are helping families and business owners. And we want to thank you for your time. And of course, you got to cite your sources. I am a psychology professor. Don't let me catch you plagiarizing. But also, this is the most impactful slide we have, which is how you can connect with us. You can take your phone and screenshot or point your camera at this, or if you're on your phone, you can just hold down the QR code. We'll also be sending you a little recap with everything you'll need to get in contact with us because we want to serve you. And unlike people who are looking to make a buck off of you, we're looking to protect you. We're in the protection business and we're in the people business.
Any questions at all? Could be now, could be later. You have our contact information. And if not too, again, everyone who registered, whether you have attended live, but you did sign up, we are going to be doing our raffle giveaway. So we will be contacting the winner. We're going to do like a little pin wheel type of thing with everyone's names on it.
We are.
And we will be contacting you. Our friend Carmen, who also has been attending as well. She creates these wonderful, beautiful planners. She's thought of everything, and we have a financial planner to give to you. Because, yes, even though we will be doing the grunt work of things to make sure that you get success in homeownership, keeping your home, staying there, and everything, there's also some work on your part, and budgeting is very key when it comes to these things. And so having that, looking at that, writing it down and reevaluating what your goals are and everything is super essential. So we will be giving away a financial planner and we will be contacting the winner. And again, we are going to send email copy of the recording as well, some material sheets to look back on, and our websites again on how to contact us, schedule a consultation meeting, because again, you're not locked in unless you want to keep moving forward. So definitely, if you're curious and you're interested in how this can benefit you or a friend or a family member, your neighbor, your hairdresser, anyone who is a homeowner or future home buyer, send them our way, and we will help them out too. If there's no questions, I think we are all good, and we'll talk to y'all later. Thank you so much again for attending.